Welcome, everyone. We have an exciting webinar today, The State of Home Equity, a strategic indicator for risk, growth, and performance in today's mortgage market. I'm Allison LaForge, the managing editor of the Housing Wire's Content Studio, and today's webinar is produced in partnership with Accurate Group. Now, a few housekeeping items before I turn things over to Josh, who will be leading today's conversation. At the top of your screen, you're going to see an option for chat, ask a question, resources, and even emoji reactions at the bottom of your screen. This is meant to be an interactive conversation. So if you have any questions for our panelists today, submit them using the chat or using the ask a question option. We will be keeping an eye on both for the entire webinar. We'll get through as many questions as we can at the end of today's session. Today's session is being recorded, so if there's anything that you want to send over to anyone on your team or in your office or share the recording, you will be able to do so. Now, today we are joined by industry experts who will be leading us through this conversation, delving into how home equity trends are shaping lending decisions across the industry. Let's start with Steve Bukowski, who is the COO of Accurate Group. We are also joined by Ken Flaherty, the Director of Retail Lending at Curinos. And as I mentioned, leading today's conversation is Josh Livingston, the CRO of Accurate Group, who will be moderating today's conversation. Now, Josh, I'm going to turn things over to you.
Thank you, Allison. Appreciate it. Ken, Steve, thank you for joining. Ken, especially as our special guest, providing great insight and data into the industry. Accurate Group, if you're not familiar, we are a leading national provider of title and valuation services across equity, mortgage, and default, leading with technology and innovative products. And our special guest, Ken, who joined us, is from Curinos. Ken, you want to give a insight into Curinos and where you get all your wonderful data?
Yeah, absolutely. And thank you to you and Steve and the Accurate Group and Housing Wire for having me and having Curinos represented here. But for those not familiar with Curinos, so we're a data provider for lenders across the country, where we have a benchmark of lenders that contribute their data on a weekly basis on originations, monthly on home equity portfolio, that we aggregate together for a near real-time snapshot of what's happening across the market. So across the page there, you see we dive into many different verticals of named lender pricing data to the origination and the portfolio benchmarks. But really just want to emphasize here, all the data or most of the data that you're going to see here today is directly from our origination and portfolio benchmarks. That's going to bring today's conversation to life. And this is exactly how we work with our benchmark of lenders across mortgage, home equity, unsecured, small business, and really trying to create those actionable insights to provide information to be able to make strategic decisions with. So you're going to see a lot of great data here today, all of which is available in our benchmark.
Thank you, Ken. So today we're going to look at just kind of the market overview, kind of utilizing Curinos' data set to give some insights to what lenders are experiencing. Steve's going to talk around some operational efficiency and risk assessment, and then we'll kind of wrap it up with strategic outlook as well as questions at the end to based on what the audience would like to hear. So diving into the market overview, it's been an interesting year. Right. The one great thing about the mortgage industry is things are always changing, and things that even outside of our control have impact to our world. We saw a lot of hope early on January, February, with rates starting to go down and create activity, especially in the refinance market based off of the last few years' higher rates. But we saw geopolitical changes. Today's inflation data, I'm sure everyone's super excited to see 3.3%, highest in 3 years. That has impact across the board. Based on that, though, Ken, we're kind of seeing, equity continue to lead the pack. and continuing to see it be really a significant tool within most lenders for not only those staying in place for home improvements, but with costs of goods and everything going up, we're seeing a lot more debt consolidation. Where do you see kind of, I mean, are you aligned with that, with just where rates are at? And, you know, where do you see kind of things start to impact with rate changes where equity and maybe cash out refinance become more of a balance versus being more equity dominated?
Yeah. So I really see home equity having a pretty sizable runway ahead for a number of different reasons. But to really kind of think about what will be the main drivers that will continue to propel the home equity market and the demand for home equity, to me, I think really boil down to three main reasons. Number one, as shown on the chart here on the left-hand side, we still have the vast majority of existing first mortgage holders sitting at fantastic interest rates. In totality, we're still nearly 50% of borrowers that are sitting at that 4.5% rate or less. Sorry, first mortgage folks, I don't see rates getting down to that point anytime soon where it's going to make sense to touch that first. So I think you still have a glut of locked in first mortgage borrowers. Secondarily, consumers are continuing to pile on the debt. And that is a real opportunity for improved cash flow. Credit card rates for the last 5 years have increased. I'm sorry, credit card balances have increased over 22%. You're talking sizable dollars per household at average interest rates of over 25%. So your borrowers, your consumers need help, and home equity is a fantastic tool given, which brings me to the third is your homeowners, your consumers are sitting on a ton of equity. And while we're seeing pockets of challenged home prices, we're still at elevated levels. So I think it's safe to say that consumers are still sitting on and retaining vast amounts of equity that I think are going to continue to propel the home equity market for the foreseeable future.
Thanks, Ken. And, you know, on the right side, you show kind of some numbers that have that sort of impact. You know, you laid out HELOC with an IO situation, driving it even lower, but even with a HE loan at a fixed rate with principal being included, you still need to see rates significantly below 6% to start having real financial impact for best scenario with the borrower, especially in debt consolidation. Is that a fair statement?
Yeah, that's how we assess it. And again, I encourage everybody to put their calculators away. This is back of the napkin calculation, but just putting yourself in the shoes of a existing homeowner that's sitting at that 3.5% rate. We're just doing that calculation of when do we think it's going to make sense? So what is that line in the sand? And does it need to get all the way down to 4 3/8? No, but I think it needs to be pretty close for a first mortgage rate term cash out transaction to make the most sense. As everybody knows, and that unfriendly reminder, I don't think we're going to be there really anytime soon. So I think a lot of those locked in borrowers are going to be continuing to look for an outlet, and home equity can be a fantastic product for that, for whether it is debt consolidation, large purchases, or as existing homeowners are staying in their homes for longer and longer because of the affordability challenge. They're going to eventually renovate that kitchen. They're going to eventually do things to make that home their home if they can't afford that next home or next size up home.
Oh, it's great insight. Thanks, Ken. This is, you talked about just the overwhelming amount of equity in homes that we're seeing with home price index growing, people, again, staying longer, principal being paid down. But what's interesting here is you see the breakdown of how people are utilizing that. And home equity, obviously, with those lower rates that you established earlier, are dominating. But even within home equity, HELOC is overwhelmingly dominating. What do you think is driving that, or why HELOC is it ease? Is it just how people are processing it, or any thoughts there on what drives HELOC to be so much more successful than HE loans at this moment?
I think in most cases, borrowers are seeing the benefits of a HELOC in a, dare I say, lower rate environment, but lower from where we were, a year, 2 years ago. And again, other than current conditions, the perception of a falling rate environment. Um, to your earlier point, HELOCs in many cases offer interest-only payments. They offer redraw functionality for a lot of depositories. They offer the ability to not have to draw everything at once. So I think there's just a lot of benefits to HELOCs, especially for borrowers using it for the purposes that we previously described, especially the debt consolidation, that IO payment, or not having that fully amortized payment at a locked-in rate where home equity loans, really shines. HELOCs are certainly going to provide the better alternative there.
Absolutely. Steve, from a processing standpoint, we've heard from lending partners that HELOC can be easier just because of some of the regulatory aspects and how they treat them and process them. Any thoughts from your perspective of why you see HELOC overwhelmingly larger than HE loans?
Well, I think part of it, and what we generally hear is ELOC offers an option for the future, right? With an E-loan, you're getting that funds out dispersed all at one time, and you're making payments on it. With the E-lock, you have it almost like it's a bank account sitting there on standby. So not only can you take out the funds you need for that payment that Ken referenced, but you also can get the future opportunity to take and draw additional funds. So instead of coming back for multiple E-loans and having to reapply, the consumer-friendly aspect of the home equity line of credit is really what drives that high percentage, in my opinion, because it gives a future options.
Thanks, Steve. Speaking of future options, prognostication is one of my favorite things for Ken to do and look at what he's seeing coming down. Looking at first mortgage first, everyone was pretty aligned in the 2025 forecast, and you guys were pretty spot on from your perspective. 26 though, there's yourself and Fannie's seeing more growth in the mortgage side, yet MBA has downgraded down to 6%. Any thoughts on that, on what drove your decisioning there and why you guys are looking at it from that perspective?
Yeah, and I will say the beauty of forecasts is you can always reforecast. Don't worry about the last one, worry about the one that's in front of you. So I certainly see additional adjustments being made as time goes on. But, as you think about all mortgage transactions right now that we're seeing so far this year, and even last year, it's between 60 and 65% are made up of purchase. Purchase is really the big lever and the big mover, and really will ultimately end up being whether or not we have a big growth year this year in mortgage. But so far this year, purchase is up very modestly. I want to say between 1% and 3% right now. So some of the bigger numbers that you're seeing out there, refinance was really from January and February when we saw that lull in rates, all for that to be taken away so quickly. So it really tells us we're really counting on a really big purchase market this season, but we've got some headwinds with home affordability, which we'll talk about. But it certainly tells us, and you saw on that previous page, if and when rates do get down closer to that 6 or even under 6, refinance can really, offer a lot of opportunities for those borrowers that are still sitting at that upper 6, 7, and even 8 handle first mortgages. So I think a lot of what you're seeing, especially from Keranos and from Fannie, is I think a lot more upside of, we think we'll still have a positive purchase market and purchase growth this year, but a lot of that is going to be founded on, as long as we're not going sizably up in rate, we should still be able to see some success out of the refinance market this year.
Excellent. looking at equity though, significant growth in 25 saw across the board, and a lot of lenders took advantage of that. Then we're looking at a relatively flat 26, but you are seeing some positive growth in the second half for some lenders. Kind of curious to your thoughts, and then after that, Steve, I'd be curious to your thoughts as well around, us doing a lot of partnering with a lot of various lenders across the country. We saw actually a pretty okay first half of the year, with some growth with key clients in certain markets. So I'd curious to your thoughts. So Ken, you first on just, what you're seeing from flat. Was it everyone advantage in 25 with all that substantial growth, and then rates, or what's driving kind of the thought process with a more flat 26?
Yeah. So I know not pictured on the page, but if I take you back to the last time the home equity market saw back-to-back years of double-digit growth was back in 2015 to 2016. So it's been 10 years. I guess in summary, it is not common for home equity to see multiple years of double-digit growth. So I'm taking this as a positive of if we're at 0 to 3% for this year, that is making some assumptions of where we think we will end this year from an economic standpoint. But we're talking about compounded growth, a growth year of 16% last year. And if we're upwards of 3%, I'm still taking that as a win to have 2 double-digit years in the growth cycle. If you're questioning why can you talk so bullishly on home equity on prior slides and then say we might even be flat this year, we really have to take a hard look at the situation that consumers are sitting in. And if anyone looks at the consumer confidence index or consumer sentiment scores, folks are not very positive about the outlook of the economy right now. And that, if you look at periods where customer sentiment is down related to home lending growth, a combination of mortgage and equity, those are down years, those are down periods. So I think a lot of this that we're seeing is that correlation of consumers are not overly positive of how the economy is going in their financial situation. So we're betting pretty heavily here that history will continue to repeat itself, that despite all the tailwinds we have going for us, everything we talked about previously, customers still make that decision whether or not they finance and pull that trigger or not and use a home equity product. I still think they'll use their credit cards and perhaps other outlets, but actually making that leap to dive into a home equity product, I think we're going to be really challenged if we continue to see a lower trajectory or more challenged trajectory from a consumer outlook type of perspective.
So Ken, a follow-up question to that then is, if willingness to spend is still there and, credit card continues to increase, is there an opportunity for lenders with education around debt consolidation and value there, and presenting it in that manner versus a safety line or home improvements or it's buying the new kitchen when they're not confident of what's going on in the economy, but opportunity for lenders to show, at 8% or 9% home equity loan is a heck of a lot better than a 22% credit card bill that you've been carrying over.
Yeah, well, 1000%. I'm so big on the more you can educate your customer, the happier customer that you're going to have, and the likelihood for repeat business down the road. At the end of the day, we can talk all day long because we live and breathe this every day. Both of you guys know this. We are not your average consumer. We're quite strange ourselves. We live and breathe this stuff. But my point is, your average homeowner, your average consumer is not this educated. They know they have a need. They know they are financially challenged. Most do not know what is that right product to be able to fulfill that. They've heard of a home equity. most people don't know what it's actually capable of or what you can use a home equity product for. So we think more we can educate borrowers on the uses and the functions and the features can help connect those dots to challenges with opportunity through our products. It can certainly make a lot of headway for continued growth in this market.
Thanks, Ken. Steve, any thoughts on, we've experienced some growth with clients' volumes going up and things like that. Do you have any thoughts on that? Is it limited to region? Is it strategy, or what are you seeing that's driving some success for some lenders while others may be a little more flat this year?
Well, and one thing I like to say on that in terms of some lenders being flat, and even the projection looking at 2026, your home equity, 3%, which is the high end of the range. Home equity is still dealing from a position of strength. That 16% 2025 growth following a prior year of double-digit growth has really had many of our lenders or our customers, their capacity at some point 2025 started hit a tier, right? They moved individuals out of refinance because refinance volume was slow. They're processing consumer loans, home equity loans, et cetera. They did not have, nor do they have this year, a need to really heavily market home equity like you see in the past. That comes right down to what Ken was saying about education. In years past, you would absolutely see lenders doing heavy marketing in spring and fall for home equity and to trying to drive applications through that process. There's been so much organic growth and need just from all the items Ken mentioned before that home equity for our lenders has already been strong and has continued to be strong in first quarter and second quarter of 2026 because they haven't really had the need to go out and market for it. Some lenders are starting to pick up market. They're doing more marketing towards internal portfolios, identifying individuals that already have a first mortgage on the books, so they don't want to lose them to somebody else who's coming in and trying to target that home equity market. But really, it's just we've been so fortunate on the home equity consumer side that the demand has been there because of the rates and all the other things Ken mentioned, that lenders haven't heavily marketed this product. Some have, and those are the ones you've seen some growth out of.
Thanks, Steve. Real quick, though, in the spirit of interactive conversations, we did have two questions come up. Ken, you may have better insight to this one. Question from George is it safe to assume that most cash out HELOC transactions are adjustable rates? I don't know if you have that insight.
Hard to answer that question without being overly factual, but yes, I think it's absolutely two parts. Won't have you back up, Josh, but on one of the previous slides, we talked about percentage of existing first mortgage borrowers that have over a 6% first mortgage rate. That population's getting bigger. It's actually bigger than the population of borrowers that hold a 3% or less first mortgage. So the longer we're in this higher rate environment, the larger that bucket's going to be and the smaller the other buckets become. So I think it's a good portion of those ARMs that we're now hitting that 5-year. 5-year ARMs were very popular. And certainly as rates got higher over the last couple of years, rates are now increasingly popular. So I would say is a portion, but I think it is much more in those borrowers that probably either bought their home or even did a refinance in those upper rate tranches that are likely kind of the bigger users of that refinance product right now.
Thanks. And when you're looking at your forecasting, Jimmy wanted to know, does property types such as a condominium have any impact on the forecast? Is there anything that carve out from that perspective?
Not specifically on condominiums. Our forecast is made up of about 25 different market correlators. There's some that have heavier weighting than others, but specifically condominiums or property types is not a factor, but certainly homeownership and homeownership rates play a very large role in those correlations.
Thanks, Ken. All right, looking at affordability and ownership rates across thing, we talked about certain markets being stronger than others. Where do you see from the impact of this? All right, you're talking about Florida in the slide showing Florida and California trending down year over year. Where do you think this has for an impact?
Well, I think a couple of things. So I think when you look at this map, and what we're looking at is the origination growth year to date this year versus the same period of last year. With some correlations that you can take away here, while it's not an exact science, but where you see more commonly of home equity originations falling are some of the markets that tend to historically, and even as of recent, have become more overheated. In particular, a lot of West Coast is, we know the story in California. So I think a lot of values were overinflated there. Now it's becoming more challenging, as values are still higher, but we're certainly losing a lot of ground in certain pockets like San Francisco and similar areas where home ownership is just too challenged, despite some of the droppage in real estate values. The values are still super inflated. Going back to the forecast discussion, again, one of those correlators, as I mentioned, is home ownership and home ownership affordability. So as you think about median income levels versus median home prices, if consumers are not filling homes and improving or at least sustaining those home ownership rates, we see that as a direct correlation of when home equity is successful or where it's going to meet some headwinds. So again, pockets like California, Nevada, Louisiana has other challenges, but certainly Florida all fall within those categories of more challenged real estate values, more challenged home affordability challenges that I think are going to continue to cause some challenges. I wouldn't say complete blockages, but just more challenges for home equity growth to continue to sustain there.
So lenders should be aware of that and planning accordingly, that there could be challenges coming in states if affordability continues to be a challenge.
Yeah.
Ken, on this slide, you talk, you demonstrate purchase volume versus refinance cash out. How do you think this has impact and the importance of tracking this from a risk standpoint and planning standpoint?
Well, I think it perfectly summarizes what we've been talking to up until this point is, left-hand side, it is green across the map. Some super high, some kind of at median levels, but we're seeing positive refinance cash out transaction, total volume up year over year across all the states. On the right-hand side, again, kind of goes to that home ownership rate, purchase volume. And again, you see those same correlations, just like we talked about on the home equity growth slide. Some of those same markets we're seeing purchase volume down. And again, I think it really all comes back to the challenge of homeowner affordability, given the rise in payrolls is not meeting the same growth rate as the rise in home values. So those median income levels are seeing slight growth, certainly not keeping pace with those median home prices, and it's putting more and more potential suitors, potential homeowners out of that bubble of being able to purchase that next home up, for a growing family or for first-time home buyers.
On affordability, can you kind of show this, and it's pretty significant, showing, from 2020, which is obviously a lot of different conditions at that time with rates and just conditions within due to the pandemic starting. But now we've seen a significant drop off, 24 and 26 of affordability. So that all ties in across the board, right? You do call out though, most expensive time to purchase home was 81 in 2006. You did reference 81 there with the interest rates, but I will point out that a house cost like $40,000 at that time. So I think people would probably pay 18% to get a $40,000 house they could live in at this moment.
Yeah, I'm not sure who in the audience here ever looks at this, but I think this is a fascinating statistic and a really good way to keep your finger on the pulse, because all of this data is free, by the way. This is not Curinos data. This is out on the Federal Reserve Bank of Atlanta site on Homeownership Affordability Monitor, and it breaks it down by specific CBSAs or states. But if you just look at things on a national level, it's pretty compelling. Of the lower you are on that scale, it is a less affordable market. So as we look at things nationally, we were headed for a pretty nice trajectory through 2020, and we all know what happened then. And now we're sitting at really challenged levels of dollars not going as far. And to your point earlier, yeah, 18% rate for 40,000, that creates its own set of challenges. But you're talking average home prices sizably above that, at rates that people in the 80s would kill for, 6-7%. That compounding factor just becomes more and more of an issue for borrowers to get into new homes.
Thanks, Ken. Oops, I think I'm delayed there. Sorry. And this kind of just shows this is a good indicator around what you're talking about with median income levels and the ratio, right? 2015 to 25, as we see more areas growing, really too, with some areas, being that 7-8 index. And that, I think this is just a good understanding for individuals of the market, where there are pockets where affordability is going to continue to be a challenge. We joked earlier that no one yet has really shared any true idea of how to get things more affordable other than rates going down, which is out of our control at this moment.
Yeah, and real quick, Josh, on that slide, I think this visual, while it's not the same calculation as the home ownership affordability monitor, it's very, very close. But this gives you that more magnified view of where we were 10 years ago, where we are right now. And again, not to beat a dead horse with this, but we're talking about the same challenges in the same markets where you're 7-8x or even over that. These are the pockets where purchase is down. This is the same pockets where we're seeing home equity down. And certainly in the central, we're seeing more positive growth out of purchase, refi, and home equity. You're certainly seeing more in that 3 to 4% range, or 3 to 4x range, rather.
So it's interesting when we look at this slide's interesting to me because we're showing application volume growth in perspective to dollars being lower than actually booked volume growth. I just kind of wanted your insight to that. Where we see again, HELOAN demand is softened, but HELOC is growing, which we've talked about earlier. But why are we seeing lower application and higher booked amounts? Is it a better credit environment for many borrowers? Is it just due to the growth and the available equity across the board, or what is the thoughts there?
I think you have a couple things happening here. If we just pay attention to the totals for a moment, again, down in applications, up in originations for that gray bar there. What you have to remember is, number one, the Q1 of 2025 felt like we were all shot out of the cannon. We were just on the heels of the Fed finally cutting rates after what felt like forever in Q4 of 24. And so we saw what we felt was a lot of pent-up demand. So a lot of that really propelled into Q1. In fact, Q1 of 2025 was the best performing Q1 that our data goes back 20 years. We can't find a quarter that's a better performing Q1 out of that entire period. So it felt like a lot of pent up demand. So you're comparing a really big Q1 of last year in terms of applications. From a booking standpoint, what you also have to think about is, and I think we'll get to a handful of these views, but cycle times still are averaging 30, 40 plus days. So a lot of the applications that we took at the end of 2025 rolled forward into January and February of 2026. So I think we're reaping the benefits, but if we were to look at this on a monthly basis on the velocity of applications versus the velocity of booking growth, and not comparing versus last year, it would tell a slightly different story where we are actually doing pretty good on application volumes month over month. We're just comparing to a really big number last year. Bookings, it's just a slowing effect of now all those applications that we really just started to get, March, April timeframe, just haven't fully seasoned out yet for that booking number to actually show its true colors there. So I still think as our data unfolds and as the market unfolds, and certainly as lenders' pipelines season out with cycle times, I think the scales will start to shift a little bit, but hopefully that provides some insights on why we're seeing some mismatches there.
Thanks, Ken. That's a good segue into the next area around operational efficiency. This is such a key component and where we see lenders having more success in certain areas than others, Steve, from, your perspective, right? We've talked about home equity being probably shining light right now out there. It's key for lender growth in 26. It's in some cases key for financial, education within borrowers. How should lenders be thinking about operational efficiency and the impact, right? Speed, efficiency, risk management, performance optimization. How does that all play in?
Yeah, and it all comes out the other end as capture rate, right? So, we had some great conversations about lenders and how they're bringing in volume and how they're getting applications, but really it's about how you execute and it's how you end up closing those loans at the end of the day. So the more equity lines, the more streamlined equity lenders have a really great process where they maximize the balance between speed, efficiency, and risk to the entity. Right. So, we talked about we'll show a little bit later, the cycle times to close, but really good lenders in the home equity space that are working with really good partners are really focused on products that leverage all those components, right? They have solid risk profiles, whether it's distribution, geographic risk, refinances versus loans versus ELOCs, or just fraud type risk, making sure you don't have losses and you're providing good products, both on the valuation and the title side, that allow that lender to know they have a very secure position and can move forward quickly. They don't have to, move quickly at the expense of quality. Speed is important, but I think some individuals or some groups tend to overvalue speed on the front end and don't look at the entire process. So, and what I mean about that is there's some really great tools on the front end, both on the valuation side and the title side, to help lenders make very quick decisions. But sometimes those tools overcompensate speed and they result in items that down the line in the back end of the process cause delays, which is how you get those 40-day cycle times on close. Title decisioning, valuation decisioning, that can all be done very, very quickly at a very high quality rate. But when you get to the closing and the convenience of a mobile closing, for example, which we'll talk about in a little bit, and RON closings, those are things that get overlooked because everybody's focused on the initial two products that drive that lending decision. And of course, in conjunction with credit and risk, payback risk and things along those lines. So working with vendors and having a strong process where vendors and the lenders work together to have a streamlined process that delivers all those components, convenience, cost, and speed, as well as quality, is key to a successful home equity lending process.
That sort of leads us into kind of borrower expectations, right? We're in a Amazon, like we have to be honest with the expectations, right? Amazon world of
Sure.
next day delivery or same day delivery. How do you look at borrower expectations, or how should lenders be looking really at borrower expectations to ensure that they do continue to capture and not have any sort of bleed to competitors?
Yeah, today is an on-demand world, right? Borrowers want convenience. They want things to move fast, and they don't want to have distractions or last-minute complications um, that complicate the process and diminish their experience. In this particular slide, you can see, they're all automated decisions. Lenders want to know, or borrowers want to know their proof quickly. It's a digital world. Most applicants now come in online or through a digital medium. There are still branch applications. Some larger lenders that have good branch portfolios and good branch sale forces can drive a lot of applications through their branches. But for the most part, it's digital. And but that borrower, once they get that application, they're happy. You get good scores, your P's, you get good reference scores, net promoter scores, etc. But if that automated data ends up causing an issue at the back end that adds weeks to a process, for example, not identifying a trust through a bad title search, or providing an AVM value that's high or low without a conditional review, like a PCR, property condition report. Those actually are more detrimental to the borrower consumer and experience, and draw that cycle time out longer than if you had just spent 24 hours and got a title report that you can depend on 100% of the time and address all issues. So really the product mix needs to be, once again, balanced about high quality, low borrower impact that's going to give them a very quick overall closing experience in a very friendly way. And it's our
That's
job on
great.
the back end to make that happen without the borrower even knowing it's happened.
So for lending partners out there, what should they be looking at for strategy and tools out there? And we got to talk a little bit, be conscious of
Sure.
time because we can go down a rabbit hole, but AI and what's actually
Yeah.
happening out in the market.
Very, very quickly. So both on the title side and the appraisal side, really for the home equity space in particular, when you're lending under the de minimis level, you want to use the products that are very beneficial and quick to the home equity environment. I mentioned AVMs, automated valuation models, but there's also hybrid appraisals that have a home inspector combined with an actual USPAP compliant appraisal. Many of those reports can be done very quickly. You have an appraiser providing an appraised value, just like USPAP, like in Den 04, but that inspector takes away some of the work product or the time frame that tends to clog appraisers up. And everybody on this call, I'm sure, is aware of the fact that the appraisers are an aging platform. We're getting ready to move to 3.6 UAD at the end of the year. So there's a very limited supply of appraisers. So inspectors and hybrid products can be a force multiplier that'll help speed things up for your borrowers, especially in times where volume starts to increase. On the title side, it's a very similar thing. Getting a high quality title product for home equity lending, current owner search, that identifies all the potential risks up front or the lack of risks within 24 hours is key. It doesn't pay to have a product that's delivered in 10 seconds that ends up having a 10% error rate and causes borrower issues on the back end, be it either over reporting or under reporting. When 24 hours, you can have a 100% solution that eliminates future borrower impact items. So it's really using your products and balancing them correctly to make sure you have a streamlined process. Once again, that's low impact. And I would say the biggest thing I see today that many of our customers are moving to is starting to take the signings out of the branch network where individuals face it. Working individuals don't want to be inconvenienced by having to go to a branch to sign Monday through Friday or Monday through Saturday, 9 to 5. That's when they're working. They're busy. They don't have the time to do so. They want either a signing that comes to them via mobile or a Ron signing that's very convenient and is fulfilled in the very same way they took their application digitally. Very high convenience, very great for a scheduling process. And by the way, it tends to shorten that lending cycle considerably because you're not trying to schedule with a notary at the branch, but you still have the opportunity to engage that consumer and close that transaction in a very friendly way with very knowledgeable individuals.
Absolutely. And, impact, you mentioned that, the title component not being done correctly has long drag in the process and clearing things, borrower experience, there's solutions out there. We've seen that, we see individuals that are not experts trying to clear title and elongating the process or doing it incorrectly and having large impact. So looking at vendor partners that can help clear title quickly and effectively and correctly is also a time saver in the long run.
Yeah, and a quality product that the vendors are willing to stand behind. If we deliver a title product, you want to stand behind that it's accurate. You don't want a, quote unquote data product that the risk is put on the lender to underwrite, and then ends up having issues at the back end at the last hour when you're trying to close a transaction and find out you can't record it because the title search missed the correct deed, there was an out sale, things along those lines.
So here you're looking at cycle time and compression there. What are your thoughts there?
Yeah, without spending too much time, because the fact that we're getting near the end here, it's really looking at every step of the process and looking at ways to shorten those process. It's not going from a full manual process with an expert to something that's done in 5 seconds. While that'd be great, it causes other issues I mentioned on the back end. So it's making sure you have a high quality product at each step and then looking for opportunities to eliminate those outliers. The outliers are really the things that extend that cycle time and provide that bad borrower experience. The appraisal that takes 3 weeks, things along those lines. That's what you have to eliminate throughout the process to be able to get that cycle time down to 15 days or less in terms of application to close and fund on a home equity line.
Real quick, Ken, this is some data that you've provided around borrowers where we see the cycle times here. From your perspective, Steve talked about a lot of the things prior about what things are doing, but you see banks and credit unions running a little bit longer than fintechs, not necessarily always the same apple to apple comparison because of how the two different groups operate, but anything quickly that you have seen from all of your insight that drives those cycle times down and drives success for a fintech closing almost 60% in under 15 days.
Yeah, so if I just kind of combine banks and credit unions and call them depositories for the moment. So commonly where we find the challenge is banks will do more of the complex stuff is probably the most fair way to say that. When I say stuff like, revocable trusts, flood properties, like stuff like that takes time. The lenders that we see doing things efficiently and that are standing out and making some ripples in the market have a differentiated process of loans that can go fast versus loans that we know are going to take some time and additional FTEs to put their eyes on. The lenders that are more efficient have differentiated processes to say your wage income, I can do an AVM, I can do illegal investing, I have all the docs. There's no reason this is going to take me 30 days. So that is going to go to the fast path versus path B, let's just call it. But if where commonly lenders fall into the traps of what we see displayed on the page of less than a third of all applications falling into that shorter window, everything else falling well over 30 days, is everybody goes through the same funnel, waits in line at the same speed. Even though I can and want to move fast, I'm stuck in the same path and the same line as everybody else.
So some value of starting to look at their overall process. We can deliver an instant title, you can deliver an instant valuation through an AVM, but if it goes into the generalized queue, you may have a long elongated process that impacts borrower satisfaction, that there's values of looking at your process as a whole.
100% in creating those caveats of the type and the quality and the situation. Like it can't just be all your HELOCs go here, all your home equity loans go here. It needs to be much more purposeful. And it even can be in the solutions and your solutions that Steve was just talking about, of we can leverage these stack of solutions for pipeline A, and we might have a more varied suite of solutions to deliver on pipeline B based upon the likelihood that borrower can close fast.
So we kind of talked on speed and the fact that, you know, we do see non-depository lenders be a little more selective of who they sometimes work with, but this is a pretty significant draw disbursement that we're seeing, right? That in the speed, meaning need versus nice to have. Any thoughts on this or what you've experienced in the last couple of years as we've seen non-depository HELOCs grow?
Yeah, listen, you know, I love fintech lenders. I like what some lenders and, you know, that are IMBs are doing in the home equity space. I think it's all good for the industry because they are changing the status quo of the borrower experience. And I think what's displayed here is when you move fast and create a pleasant borrowing experience, you're going to, in many cases, attract that borrower that is motivated to move fast. They have a need, and they are motivated to move fast. So the one important thing here that I will mention, and just make sure we're all on the same page with this, is, yeah, a lot of those non-depositories like the fintechs of the world, they have required draws associated. So a lot of the pushback I get when we look at this, a view like this, is, well, you're forcing the draw on the right-hand side, but it's a draw on demand on the left-hand side. Totally fair statement, but if we're talking about we're all competing for the same borrower for their needs, at the end of the day, why is there nearly a 50% or 40% gap in, you know, the balances that fintechs are getting on day one of that HELOC? It can't be because you sell a different product. If we're talking about the same borrowers with the same needs and the same opportunities, it really is highlighted. What you see in the bottom is, if I can deliver something 3 to 4 weeks faster and have a seamless digital end-to-end experience, those are the customers that need money, and they need money fast. And that's really what's at risk here if you sit back and don't do anything about your borrower experience or your fulfillment processes.
So that kind of leads into where we see the next kind of, when you look at the generational aspect of it, of where people want to be met, you know, boomers generation, mostly in branch, you know, going down to Gen Z being mostly, you know, looking more digital experience as it goes down, meeting the borrower where they want to be, having that experience, having online application and faster qualification has an impact. Anything?
It has. Sorry, go ahead.
Oh, say anything else? I'm weird. I'm a Gen Xer, but I still go in the branch for everything.
Yeah, I've been called a couple of times. I don't really appreciate it, but I've been called a geriatric millennial. So it is what it is. But I'm with you. I like a branch, but I couldn't tell you the last time I've been in a branch. But for our audience here, I think what you take away from here is we have to understand who's next up. Who is our primary target customer right now? I'm not going to say any of these generations on the page aren't your customer, but you can probably pick which generations are likely going to have the most opportunity, i.e., it's not the generation with all the equity, it's the generation with the debt. And when you look at that, when you look at it through that lens, the generation with the debt and with the needs are certainly the ones that are saying, I like a branch, but I prefer to do my transactions digitally or through a phone call. Don't make me put on shoes and get in the car and drive to a branch to submit an application or to close a loan. make it easy for me. And it really ties back to that previous slide. If you make it easy for me and we can do it fast, these are the generations that are saying this is their much more highly preferred mode of entry of how they choose who they do business with.
With that, you know, there's the slide. Sorry, it's a little delayed here. You know, cycle time, 2+ weeks to fund. This is an interesting slide because we talked about the products early on making the decision, but then we're seeing from approved to booking, in some cases, taking a week or two. What do you think's causing that, and what is the impact there? What should lenders be thinking about to shorten that to benefit from the impact and borrower experience?
Yeah,
that can be
my
for
opinion,
either of you, Steve or Ken.
I'll just give a quick 2 cents and hand it over to Steve because you have the solution, but we're on the same page there. To me, 2+ weeks after the loan has been final approved to actually put money in hands is way too long. You know, the loan is done at that point and the borrower is waiting for their money. I like to think of myself as a patient person, but telling me I'm approved and I don't get that money for 2 more weeks would be quite frustrating for me. So we need to find those solutions and deliver those solutions that we are able to meet the promptness and the expediency that borrowers are expecting through other solutions to be able to shorten that to, you know, 2 to 3 days versus 15 to 16 days.
No, agreed. And Steve, this kind of cues up because we have some questions around, you know, what are you seeing lenders do to shorten this cycle and driving success in their programs?
Yeah, and I see we only got 3 minutes here, so I'm going to rapid fire through this, Josh. So really, you know, on the front end, as I mentioned before, a good product mix that identifies and eliminates issues before you go through the whole entire approval process. You don't want unexpected issues popping up 3, 4, 5 days into the process. You want to have good title and you have good valuation soon. It should be less than a week to have that, and it's not going to give you surprises or complex issues. You want your vendors to be eliminating issues for you and solutions as opposed to creating them down the line. And on the back end, you know, you have up here on the slide, you know, the screen, you know, RON or mobile notaries is really what we see best in practice in terms of getting a good, convenient closing done quickly. Also happens to be great to prevent fraud, which is identity fraud is one of the largest issues we're seeing today in the market. You know, if you're doing a mobile signing and you do it at the actual securitization property, that eliminates identity fraud in the vast majority of cases. Those individuals may have all the data, they may have fake IDs, they may have all the information, access to your credit bureaus, etc. But if they don't have access to the house, that mobile signing can't occur in that home. Same thing on the RON side. You know, no one wants to commit fraud on video because now you have proof that fraud was committed and it's a lot easier to prosecute. So what we see today is fraudulent identification. Generally, those deals cancel and don't close when they're told that the mobile notary is either going to come out and sign at their house or if it's going to be a recorded video transaction. So we have been very fortunate in that regard that we've been able to prevent some fraud cases and provide a very convenient borrower-friendly or consumer-friendly signing process with a very knowledgeable individual who's trained to identify fraud.
And we're kind of down to the last minute here. You know, one of the things too, though, is we see for success with a lot of lenders is those that have fully integrated into their LOS systems, strategic partnerships there, where elimination of manual entry eliminates mistakes. It just makes things move a heck of a lot smoother and more effectively. And we think that's a key component to look at who your LOS is tied into and who they can partner with to create that efficiency on your side. In the last minute, Ken, Steve, any thoughts on summarizing just the strategic playbook around home equity is still going to be a large player in 26, a great avenue for borrowers, but what should lenders be looking at as we wrap this up?
Capture rate, great borrower experience, and moving quickly through the process without sacrificing those other components, risk, quality, and borrower comfort for speed. Don't just sell out for speed. You want to have a very quick product, but it has to be an accurate product.
Ken, any final thoughts?
I'll summarize. We had a question in the chat of, what are examples of lenders that do an exceptional good job of selling HELOC products? It is having the right products, an educational-based sales process that helps educate the borrower, helps educate your fulfillment staff of the needs of that borrower, wrapped into having the right suite of solutions to be able to expedite that borrower through the process. That is 9 out of 10 times, that is exactly what we see of lenders that are doing it right.
And then Allison is back.
I am back. Steve, Ken, Josh, webinar time goes fast. To our audience, I know there were many questions that were in the Q&A, and there are a couple in the chat. Rest assured, we will be turning them over to Steve, Ken, and Josh so that they will be able to get back to you with answers. I want to thank our panelists for their insights today on the evolving state of home equity in today's mortgage market, and thank everyone who attended today's webinar. We appreciate your time and participation. As mentioned in the beginning of the webinar, Housing Wire is passing out a recorded version of today's session that will be sent to all registrants. So if there's anything that you want to go back, visit, look back at the data for, you will be able to do so in the on-demand version. Thank you so much for being with us today. We hope to see you all again soon.
Thank you.
Thanks, Allison.
Thanks.